Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In this video we will be checking out one of the best performing companies in the S&P 500, in the Nasdaq, in the stock market generally. Okay, and this company is Nvidia. Nvidia has done absolutely amazing job in terms of performance, in terms of revenue growth, in terms of EPS growth, in terms of generally margins improving. It's done absolutely amazing over the last year and a bit. And what I would like to do today is look what is driving basically this company to be the probably one of the biggest companies in the world. Just only a couple of weeks ago, it was the biggest company in the world. But since then, it lost almost $1 trillion, which is absolutely ridiculous and shows you how volatile this stock is. So what I'm going to do is I'm going to talk about some of the financials. We're going to talk about the business side of things. We're going to talk about everything that we need to know about this company. And at the end of the video, I will show you exactly what I think in terms of price wise. If I was to buy this company, what price would I pay for? And that is generally what I would like to share with you guys today, because I have been getting a lot of questions with regards to Nvidia and Broadcom. I've got a video coming up soon, inshallah. I will let you guys know. This is my portfolio. As you can see here, this is real money. This is not fake money. This is money that you've seen go up and down over the last 4 years, and inshallah I will continue to share with you guys. If you want to know exactly what I'm buying, what I'm selling, when I buy stuff for the family portfolio and so on, then join us on the Patreon account, where you get access to a lot of things. And right now everything is half price, so you can join it just paying half of the price that we usually pay for. Right, so the company we're talking about, like I said, is Nvidia Corporation, and this company has done absolutely amazing job. For the 1 year, it's up 21%, which is not a lot in comparison to some of the companies out there. A year to date is down 16%, hence why I'm looking at this company. At some point it was trading $153 per share, and right now basically we're looking at $112 per share. The lowest it's been is $75 per share, so it's been quite, going up and down a lot. As you can see, Wall Street thinks is strong buy, Quant is saying is a hold, almost a buy, and we've got Seeking Alpha Analyst who are saying is also a buy. Currently has a forward PE of 25, which tells us basically the stock might be actually a good buy right now. So we're going to look at a couple of things first before we look at the financials. And there are a few headlines like this one here, okay, that basically saying potentially it might be undervalued and so on, and we need to look at that. But what I'm going to do now is just look at the financials, what they've reported on February basically this year, the latest quarter. So sales grew by 78% on AI demand, and company gives a strong guidance moving forward, hence why this stock's been doing absolutely amazing job. Basically, the company's revenue in the quarter rose 78%, and full fiscal year revenue of Nvidia rose 114% to $130.5 billion. That is absolutely crazy. Okay, that's the full year, but that's ridiculously basically crazy. The Nvidia said it's expected about $43 billion in the first quarter revenue, so this quarter, plus or minus 2%. Which is basically the analysts were expecting about $41.78 billion, which is basically higher. They're basically expected, what they're expecting is higher than what the analysts are expecting. To show you guys a couple of more things, so you can see here the revenue was basically for the quarter. So it was $39.33 billion against the 38. So they've beaten the estimates we're expecting. 89 cents when it comes to earnings per share, but 84 is what was expected, so they beat that. This is the information that I shared with you guys already. And one of the things that I've noticed about this company is the margins are massively improving. And check this out, the first quarter forecast implies year-to-year growth of 65 percent from last year. And that's a slowdown from 262 annual growth in the same period basically last year. So again, the 65% is basically not slowing down at all. And one of the main products that they have is called Blackwell, is actually doing absolutely amazing, and that's used for next generation AI chip. And the net income, check this out, net income during the quarter rose 22.09 billion basically, which is about 89 cents per diluted share, and basically that was against the 12.29 the last quarter, which is absolutely crazy. So that doubled, okay, from basically a year before. again, wherever you look at, this company has done an absolutely amazing job. Nvidia reported 73% gross margin in the quarter, which has down was down 3% as an annual basis, which is, again, you see that and you're like, it doesn't matter what it is down, it's still doing an absolutely amazing job. So whatever you look at is doing absolutely amazing. And look at just this part here. So the data center is basically where they're making a lot of their money, and I'll show you exactly basically what that looks like now in comparison to the rest of their business. For example, look at what basic data center is doing. $35.58 billion for that's Q4 of 2025. I think they report slightly early, a year early almost. So out of the $39 billion, 35 of that comes basically from just data centers. And as you can see here, from basically Q1 of 2024, look at the growth from 4 billion to 10 billion, 14, 18, 22, 26, 30 to right now 35, which is absolutely amazing if you think about it. So this is one of the reasons why the stock has done absolutely amazing, because people are seeing this type of growth. When the company is growing revenue, when the company is growing EPS, of course, the only outcome will be the stock price to go up with it, right? And that's, for me, one of the most important part. And if we look at the expectations for moving forward for this company, it's ridiculous. If you look at quarterly, for example, you're looking about year over year of over 50% growth almost every single year for the next whatever years. And look at how many analysts are looking at this company, 25 to basically 37 every single quarter. And then when you look at the revenue, 66%, 60%, 50%, almost 50%, 30 something percent, all the way down to 2027. That's basically quarterly. Now, if we go back to yearly or annually, what you see is 50%, 27%, 12%. So a slight decline in 2029, okay? And there's not that many analysts looking at that. And then when you look at the revenue side of it, more or less the same. So for the next 3 years, you've got absolutely nothing to worry about. And potentially, if they continue innovating as much as they have over the last whatever months and over years, potentially they might be still in a very good position. So when you look at the stock itself, the reason why the stock, if you look at the last 5 years, is up so much, it's not because of just a chance, it's because of that growth. And basically, investors are paying higher premium for this stock because they know the growth is there. But again, it's that risk that I'm worried about, and I will talk about that in a second. Okay, so up 1,736% over the last 5 years. I actually used to own this company. I think it was around 2020. If I had to hold on to that company, I would be up this much right now. But I actually sold it because at the time I felt like it was overvalued. But at the time, there was no AI boom. And this is one thing you need to think about when it comes to technology companies. Okay, Broadcom is actually up a lot more, which I've actually just seen now in comparison to Nvidia. So if we look at for the last, for example, 6 months, Broadcom's up about 26%. And Nvidia is only 6% up. I really didn't realize that. I didn't realize how much Broadcom is done. I knew it was up a lot, but I didn't think it was that much in comparison to Nvidia, of course. Last 3 months, this one is up 15%, but this one is down 19%. Okay, so there are other companies that have done actually better, but this company has the growth, and I will be checking Broadcom inshallah very soon. Also, I'll let you guys know. So I will talk about, in terms of, now we're going to talk about the financial side of it and see where this company is at. And the first thing I'm going to do is look at the financials, look at the revenue growth from $5 billion to $130 billion basically in 2025. So over the last basically 10 years, look at how much this has grown from 5 to almost 6, 9, 11, 10, 16, 26. And just look at the last couple of years because of the AI situation. I don't think this can continue forever, but of course it's been absolutely amazing. And look at the cost of that revenue, only $32 billion, 97. This is why they have a very higher gross profit margins. $97 billion of that becomes gross profit right now. Now, when we look at the basically couple of things, for example, research and development, you would definitely expect the company to put a lot of money back into the company, because look at this, the research and development side of it, about $13 billion. Okay, you've got about $3 billion on that one, and the other expenses about 16 billion. So they're spending quite a lot of money because they are still on that growth trajectory, if you like. Net income we're looking at right now, $72.8 billion of net income, which is absolutely amazing from that $130 billion, which is, I love that. I really, really like that. I like the fact that the gross profit margin is very high, especially a lot of software companies are like that. But this company has a hardware side of things, okay? So that's probably why it's not the same. They do have some hard software and some hardware, but mainly the hardware side of things, right? So when we look at the liability side of things, if we look at the current liabilities, which is $80 billion, total current assets, sorry, against the total current liabilities, which is about $18 billion. So they've got more money, basically the more assets than liabilities. So 32 billion when it comes to total liabilities against total assets of $111 billion. So the company is in a very, very good position. Absolutely nothing to worry about. And now what I'm going to look at is just kind of give you an overview. The company has a wide moat, is very volatile, like I said at the beginning. Current PE, we're looking at about 38. I think that this is non-GAAP. Forward PE is about 25. We've already seen the 5-year average for this company is 63, and the sector median is about 20, basically 23. So 63 for the 5-year, and currently expected next year to be about 25. That's way cheaper than what you would expect from a company like this. Free cash flow, we're looking at about $56 billion of free cash flow right now, of that net income that we saw over $70 billion. Okay, free cash flow compound annual growth rate for the last 5 years, we're looking at about $73 billion. That's massive growth. Okay, profit margin, return on equity and things like that, absolutely amazing, nothing to worry about. Return on invested capital, net income margin, compounding annual growth rate, the revenue side of the growth, EPS growth the last 5 years, and current ratio, we've already seen we have more assets than liabilities, which is absolutely fine. Now looking at the next year, we said about 50% in growth expected. I think that's what it said. I don't know if I've updated because I planned this video a couple of weeks ago. So yeah, about 50% is basically where it has been, where it's going to be basically, and then 56% when it comes to the EPS, when it comes to revenue side of it. So absolutely massive growth. Current price, we're looking at $112 per share. Morningstar is saying it's 130. That's 3 stars right now. Simply Wall Street is actually saying is about 7% undervalued at the moment. $127 per share is basically, at the time of planning this video, this is basically where we were. If the price has gone up or down a little bit, this might slightly change, so don't basically shoot me in the head if these numbers do not add up a little bit. Okay, fair value right now $175 per share according to Refinitiv ratings. That's 55% upside from where we are, and it's a buy from them. Looking at tip rank, for example, $177 per share, 60% upside from where we are. It's a strong buy from Seeking Alpha as well, 56% upside from where we are, $172 per share. So it looks like it's undervalued based on all this, but we will look at our valuation as well and basically take some of these into consideration. And as you can see from Sharia compliance side of things, company has almost zero debt, and interest-bearing securities is actually very, very low. They have been buying back their own shares over the last couple of years, which is actually nice to see. And of course, they pay the smallest dividend. I think it's like 4 cents or whatever it is, the smallest dividend I've ever seen. That's why I have not included that information in here. So we know the company is doing really well in terms of the financial side of things. In terms of growth side of it is absolutely there. But what is the right price for this company right now? Is it overvalued? Is it undervalued? Let's put it all together. Okay, so we got Morningstar valuation, which was 130, not 140. Okay, we have the Simply Wall Street. Sorry, I had to update that bit there. So $130 per share, 172 we've already seen, 127 we've seen already Wall Street, Simply Wall Street. And then this is, by the way, this information that I was sharing with you guys here. And then we've got $150 per share from the discounted cash flow model that I used, which I was very, very conservative. I wasn't basically too bullish on this company, but again, 150 seems kind of sort of in line with basically some of these analysts and what they've said. So all in all, we've got $145 per share. That's basically the price we should be paying for this company right now. This is how much it's worth current based on the information that we have. Again, you have to take with a pinch of salt some of this information, because some of these analysts that are basically get paid, okay, don't forget that, get paid to actually do these things for living, and they have to come up with some ridiculous valuations for these companies sometimes, just to kind of boost basically the stock prices and so on, so they can get their commissions. So stock price right now is $112 per share. That gives us about 29% of difference between the current price and the intrinsic value, and the intrinsic value price. So you might say this is a huge company and is very volatile. I need about 25% or even higher. Okay, so if you said that, sorry, the formula is a bit messed up, but it's 25% in terms of difference wise. So if you are putting yourself basically saying I need a margin of safety of 20%, and I genuinely think this is probably one of the most important part of this video. These companies are absolutely amazing. What it's doing is really great, and it will continue to potentially do amazing job. But now the issue is, if you are paying $112 per share right now and the company is worth less, basically what you're betting on is the company to continue doing what you expected it to do. But the issue is, and like I said it last night in one of the videos, if basically the company reports slightly lower than what's expected, it will tank and it might never go back to where it was. If you don't believe me, look at a company called Cisco and where it was in 2000 when basically the bubble crashed or whatever, and where it is right now. I'm not comparing the two like for like, but that at the time where people were writing and saying basically Cisco is going to be the first $1 trillion company, right? It has never reached that. Have a look at the price it was and where it is now. And this is why I'm always careful buying companies that are really expensive, especially if people are expecting the stock to grow this much. If they come back basically next month and basically report, I don't know, 25% basically year-over-year growth in terms of revenue, or by the end of the year, then the company would go to tank. And when that happens, it's very difficult for these type of companies to recover from that, because nobody else, because the growth, if it starts declining, look at Apple, for example, is right now is expected to grow single digits. It was a company that was expected to grow at least double digits every single year. These companies do go through this type of things, and it can happen. A lot of companies and a lot of people are coming out now with the DeepSeek, and all of these companies have come out and said, you know what, you don't even need that much power to basically to do what ChatGPT and other companies are doing. Despite all of that, I know companies like Microsoft, Amazon, all these other companies, and Google and so on, are investing a lot of money with Nvidia, okay, to buy their chips so they can actually have the best chips out there. China again is basically trying to get hold of this. They actually got caught recently. I don't know if I shared this with you guys at the beginning, but they got caught at the recently because they were using Singapore. So people were buying basically the chips from Nvidia for Singapore, but again, smuggling into China, which is basically Chinese ways of trying to get hold of these chips that they need for their next generation basically devices and so on. So yeah, just be mindful, be careful. I don't own this stock right now. Right now, if I was to buy the company, it's basically the stock, I'll probably get into, let's go back here, let's have a look at where it has been. Probably in the 70s if I was to buy in this company, and if it comes down to at least $70 per share, potentially with this type of growth, I will be looking at it. I will genuinely be looking at it if that was the case. But right now, for me, it's a pass. I'm not going to invest in this company yet. I'll wait, and it can happen. Look at it basically where it was not long ago, so basically $75 per share, and right now it's coming back again. At one point it was 150, and then it came down all the way to 75. So it can easily happen. Be mindful, be careful. This is what I want to share with you guys today. I hope you enjoyed the content. If you are, join us on the Patreon account. Have a wonderful day. Assalamu Alaikum.